So I just wanted to feature Ford because I did again, being a little bit more nimble, seeing some stuff happening. I did some quick premium trades. So I own Ford stock anyway. So say for instance, I got some Ford and my cost basis right now, it's a little lower than what I'm about to say, but because I've been selling premium on and off Ford for a while, but let's say our break even price is $16. So right here, I got a signal. This was on March 31st. On March 31st, I got the signal. March 30th, I'm sorry. On March 30th, I got the signal to sell some premium and buy some protection. So let me tell you about that deal. So I bought the $18 or I sold the $18 premium. And on that $18 premium, I made 35 cents. Now, this thing was going to expire on April 14th. Now, this says April 15th, but April 15th is a market holiday. So they're actually, next week is monthly expirations for April. And it's the rare occasion that the monthly expiration is going to be on a Thursday instead of a Friday, because Friday the markets are closed. So April 14th, this thing's going to expire. And it's when I sold it, I made 35 cents. I took that 35 cents and I bought myself some protection down here at the $15 mark. Again, this was the April 14 option. The protection I bought was the June 17 option. So that gives me a little bit more time. So June 17th, $15, and it cost me 55 cents. So I took that 35 cents I made by selling premium and I paid for the 55 cents. So I only had to take 20 cents out of my pocket to buy this protection. So fast forward, we're at a point today that I'm going to be selling this June 17th $15 put back. Let's take a look at what the price of that is right now. So if I come over here and I take a look at June 17th, $17, $15 put. The $15 put is currently, I paid 55 cents. And if you subtract out the money I paid in my premium, I paid only 20 cents for it. It's now going for about $1.20. It's $1.16.5 right now. So if I sold this right now, I'd walk away with 5 times return on investment, right? I would have made over a real nice 400% ROI or 500% ROI, something like that, on that 20-cent investment. On the flip side, if you take a look at that $18, I keep going all over the place, the $18 call, I can wait, right? And a lot of people ask me this question. They're like, do I have to really wait till the expiration date, which is next Thursday? No. The answer is no. What are we waiting for? We're waiting for the value of that option worthless. Well, look at the value of the option as of today. If I go ahead and highlight this, the price of this option today is 2.5 cents. For the most part, it's worthless. So I could go ahead and back, not have to wait all the way to next Thursday. I could take care of that obligation right now, buy that back, sell this protective option back, and now I just own a Ford stock, and I've reduced my break-even price. I made a huge paycheck on filling out that protective option. So this is a clear example of what you can do with options, especially when you have an underlying symbol, right? I went long on Ford. I'm long on Ford. I own the Ford stock. But when Ford stock starts to work against you, that perfect opportunity to sell your premium and buy your protection, because selling the premium offsets the cost of the protection, which you'll be able to roll out as soon as the pullback against you is over. And when you roll it out, you're going to make a huge killing on the back end of protection sale. Every time we roll out protection, especially if we offset the cost by selling some premium of the initial purchase, we make a killing. And that's what we did on Ford.